Disastrous, ISO, unbelievable, overreaction, JobKeeper, putting on weight. Just some of the words that I heard people use to describe year 2020. A couple of weeks ago, our own fee nerd Teke Tu CA has given you his 3 tax saving tips for year 2020. And since then, I have been asked by many for my own 3 tips. So I have taken on the challenge and let me share mine with you. My name is Alan Leon and I'm a chartered accountant and aka fee nerd. For those who are new to our channel, we give you practical finance and tax tips while keeping the tax man away, so please subscribe. If you run a business and have trading stock, now is a perfect time to have a good hard look at the value of your trading stock on hand to see if they would give you a better tax outcome. Generally, the value of trading stock on hand as of June 30th is added back as a business assessable income. However, there are more than one way to value trading stock. Say if the value of your trading stock has taken a hammering because of COVID-19 or due to the closure of your business or simply had become obsolete. You may be able to value your trading stock at below cost. For example, market valued, which would mean you pay less tax. Teke mentioned last time about the instant write-off limit increasing to $150,000 for businesses turning over less than $500 million. I've got 2 pieces of advice for you. 1. The concession has just been extended to 31 December 2020. So if you have been having trouble getting the right piece of equipment in store and ready to use at work as of June 30, 2020, you have just got more time. Although the exact timing of claiming that deduction would depend on when the asset is in store and ready to use. Second, for small businesses turning over less than $10 million that use a small business pool, if you had bought a piece of asset costing more than $30,000 before 12th of March 2020 and your closing pool balance before depreciation is less than $150,000, you probably would be able to write off the entire pool balance this year. What's that again? Let me give you an example. Let's just say the opening pool balance at the start of the year was $40,000 and you purchase a piece of equipment for $105,000 in September 2019. So your total pool balance before current year depreciation is $145,000. And because the balance $145,000 is less than the $150,000 threshold, you will be able to claim a tax deduction equal to the entire balance of $145,000 in one go. This is probably what I call a once-a-lifetime opportunity. Your ability to contribute more money in super can be affected by a number of factors, including how much money you have in super every year. For example, if you have got more than $1.6 million in super, you probably cannot make any more non-concessional contributions. And likewise, if you have got more than $500,000 in your super balance, then you will not be able to take advantage of the catch-up concessional contribution concession, which would have allowed you to put more than $25,000 in your super in 1 year. Now, like it or not, COVID-19 has an enormous impact on the stock market and the property market all over the world. So if you're one of those who have just happened to be hitting the $1.6 million or the $500,000 limit and wanting to put more money in super, you may want to pay some very close attention on the value of your super investment as of 30th of June 2020 to see if the door for more contributions may just open up for you on 1 July. Now you've heard mine and Teke's favorite tax tips. Let us know which one you like most. Or it could be one that Teke and I may not have covered. That's okay. Now, of course, I hope you have enjoyed this video. And if you like what you have just seen, make sure you subscribe to our channel so you won't miss the next episode. See you at the next video.